So we'll discuss the November 24 exam question number 1. It is largely a question which is based on similar lines. There might be an adjustment or two which is different, but let's try to address this question. Okay. So this is the compulsory question. Let us review this. If it is there in your books, it would be there right at the end. Otherwise, you can refer it from your November 2024 main exam paper. But nevertheless, let's review this. The balance sheets of H and S as on 31st March 2024 were as under. So you have been given the balance sheet of H as well as the balance sheet of S. So if you glance through this question, you will have a PP, then financial assets comprising of investment. The investment is only investment in S. But at the same time, you also have investment in 1000 debentures of S. And hence there is an intercompany debenture elimination adjustment. Inventories, financial assets including due from S at 160 lakhs. Dividend receivable is there. Okay. So this is a new adjustment, dividend receivable of 320. Cash and cash equivalents. You will have other equity, 13% debentures. Then trade payables. Achha, here you have due to H of 120 lakhs. So usually intercompany numbers usually tally, but here the trade payable is 120 lakhs. Trade receivables के अंदर 160 lakhs. Maybe that may be due to cash in transit. That is, in my books where I have to pay you, I have written and given you a 40 lakhs check, and hence I have passed the entry payable account debit to bank. However, you have not received the check, and hence you have not yet passed the entry, and hence you will definitely eliminate 120 and 120. For the remaining 40, you might have to show it as a cash in transit. We'll have to see that. Achha, then there is another dividend payable which is there of 400 and other liabilities. Okay, going further on the additional information, you will have on 1st April 23, S had 400 lakh shares of rupees 10 each and 3 lakh. So this is 400 lakh shares. So if I had to find the stake, how much would be the stake over here? Well, total there seem to be 400 lakh shares in S. Okay. So on 1st April, S had 400 lakh shares only. So this is 1st April 23. Today you are given 31st March 24. So 1 year back also, your total share capital remained the same. And 3000 in its retained earnings and other equity. H had acquired 80% share in S on 1st April 23 at a consideration of 5800 in cash. Perfect. So over here there is an 80% stake, which means how much belongs to the NCI? 20%. Following changes in the book values of identifiable net assets of S as on 1st April 23 were considered for arriving at the fair value of net assets to record the changes in fair value on the said date. These changes in fair value, are to be considered while drawing the consolidated financial statements. So you have been given for PP as well as inventory, the book values as on that date and the fair values as on that date. So there will be a bit of adjustments. The rate of depreciation for PP is 10%. Perfect. This is a fair value adjustment. Inventory, they have not told you whether that inventory is sold or unsold, so you will have to probably make an assumption. The NCI was to be measured at fair value based on the purchase consideration, based on PC. So whatever is the PC, maybe you can say if the PC is 80% is 5800, then for 20%, what will be the value? That is the fair value of the NCI. So over here, you will calculate goodwill based on the full goodwill method. Are we clear with this? Okay. Goodwill was impaired by 100 lakhs, but this is an impairment using a full goodwill method. So this is for goodwill, H sold goods worth 200 lakhs to H on credit at a profit of 20% on sales. 50% of these goods were still lying unsold. So this is a downstream sale. Further, S issued a check of 40 lakhs in favor of H in part payment of the goods purchased in March 24. This check is yet to be received. Even if this adjustment was not given, we could have inferred, looking at the difference of 120 and 160, that this might be a cash in transit. Okay, and this is dividend payable, represents the dividend declared out of the pre-acquisition profits. H has credited its share of dividend from S to its profit and loss account. So we will have to see what is to be done with dividend payable. There is a separate ledger of dividend payable which is appearing. But can I say to whom is this dividend ultimately going to be payable? Can I say this is going to be ultimately payable to its shareholders? And hence, unlike other liabilities which are payable to outsiders, there are various ways in which you can solve. But can I say this is also attributable to owners out of which can I say 80% is going to go to the parent, 20% is going to go to the NCI. Are we clear with this? So ultimately, when you look at other equity is also analyzed. Usually other equity is attributable to parent and NCI. Liabilities to be paid to outsiders. Dividend payable is also attributable to parent and NCI. You might say that for a subsidiary it is a liability. However, in subsidiaries SFS it is a liability. In CFS this is going to be paid to whom? Out of this 480% is going to go to the parent, which is appearing over here. 320 receivable, and the remaining 20% is going to go to the NCI. 80 is going to be attributable to the NCI. Are we getting this? So we'll see what is to be done over here for the dividend. So your steps would usually be in step number 1 for your November 24 exam question. In step number 1, you will usually prepare the consolidated balance sheet. Again, there can be alternative presentation formats, alternative steps, but I'm just running you through a usual step base. So over here, let us say you will start with H Limited and its subsidiaries. So you will have H Limited and its subsidiaries. Within this, you will say consolidated balance sheet. Consolidated balance sheet as at, can I say 31st March 24 you have to find. So you can probably draw up a schedule 3 format. I'll just do it in a bit of a rough way. But otherwise, you can say you start with assets. Within that, whatever are the assets you will mention. So over here, in short, you will have a non-current assets. Within this, you will have a PP. Always separately write down goodwill, even if it is not there, because there might be a goodwill which will come. Investments are there, but investments will usually be eliminated. Then you have investment in shares and debentures, both will be eliminated. Within current assets, let's say point 2, you will have current assets in short. You will have inventories and you will have financial assets. Within financial assets, trade receivables in short, and cash equivalent in short. Okay, so over here, this will give you your total assets. So there is dividend receivable as well. But let's say we leave a line. This will be an intercompany item. What is payable by the subsidiary is receivable by the parent, and hence it will not really make it to the main balance sheet. So over here, you will have point number 2, and point number 2 will be equity and liabilities. Within equity and liabilities, you will have equity. Within that, equity share capital, other equity, and non-controlling interest, which is also a part over here. Point 2 is non-current liabilities. Within non-current liabilities, do we have anything? Well, you have debentures. So you will have financial liabilities. Within that, you will have borrowings. And the borrowings over here seem to be debenture borrowings. Point number 3 will be current liabilities. Within current liabilities, you will have trade payable, also some dividend payable and other liabilities. So we will look at financial liabilities. Within that, you will have trade payables. It's a standardized format. And well, there is a dividend payable, yes, but again, I would say that this dividend is payable to whom? Well, it is payable to the parent, which is there in the dividend receivable, and hence out of 400 which was payable, 80%, that is 320, is going to be received by the parent, and hence that will be eliminated. The remaining 80 is payable to the NCI, and hence I will attribute that 80 to the NCI rather than showing it separately as a payable, because if I show it as dividend payable, remember the shareholders of the parent are only the shareholders which will be appearing in the consolidated balance sheet. This 80 is not paid to the shareholders of the parent. This 80 which is remaining is going to be going to the NCI. This is not a dividend distributed by the parent, it is dividend distributed by the subsidiary, and hence I will attribute the 80 to the NCI. So over here, if you want, you can note that down, but nevertheless, in general, I believe we will attribute that 80 to the NCI, and then there will be other liabilities. Now you can prepare notes in detail. Currently, I'm just showing you notes in a summary form so that you can probably have a clear understanding. What do we do as a step? We will note down all the assets, you will note down all the liabilities in the way it is given in the question. So when we look at the notes to accounts, let's say notes to accounts, you can prepare this in a vertical format, or for simplicity, currently I'm just doing this in a horizontal format. So this is H, this is S. If there are any adjustments, you can note that down. and then that will be the total that will appear in the ZFS. So at this level, what you will do is one by one, you will note down every item. PP, acha, वैसे investments are there, but that will go 14,800 and 6,000, 14,800 and 6,000. Then you have investments. In equity shares will go in the goodwill working, but investment in debentures will come over here. So let's say investment in debentures of 1,500 will come over here. Next, you will have, for example, inventories 2,600 and 2,000. ये सब same का same copy paste you can do. Inventories 0.4 will be trade receivable. You will first write the entire trade receivable and then see what is to be done. And then this is cash and cash equivalent. Acha, before that there is also a dividend receivable. Okay, so there is a dividend receivable as well. So if I look at each of these numbers, this is 4,000 and 3,000, 4,000 and 3,000, 2,600 and 2,000, 500 and 2,000, this is 500 and 2,000. Further, there's a dividend receivable of 320 which is currently appearing. Okay, next you go to point number 7, which will be your 8% debentures. Share capital data we will show separately. So this is 8% debentures. This is, I think, appearing at 3,000 over here, and hence this is 3,000. Trade payables is 1,700 and 600. This is, let us say, trade payables 1,700 and 600. Then you look at dividend payable. We'll see what is to be done over here. There can be alternative presentation formats, but let's say dividend payable. This is payable to whom? Well, to the shareholders of the parent. That is, it is payable to the parent, and then it is payable to NCI. This is 400. And then last May, you'll have other liabilities. Let us say there are other liabilities, and that's about it. So at this point, 1,500, and you will just be left with the share capital and the reserves and the investments. So point number 11, you can say equity share capital. This is going to be the parent's share capital, which is share capital of H. You can just note down how many shares are there. So there would be, I think, 1,000 equity shares of rupees 10 each, and hence ultimately this will come to 10,000. Then you'll have a note separately if required for other equity. Within other equity, you will have the consolidated other equity, which will come from working note number 1. And if there's any capital reserve, that will also be taken. This is retained earnings. Let us say this will be, in short, RE, that is retained earnings. Okay, so this is your standard format, and after that, you need to prepare your standard working notes. Working note number 1, which is on consolidated retained earnings. So this will start with standalone parent. So you will have standalone H. How much is that? Well, this is 16,320. 10,000 bhi leke rakha hai, 16,320. Okay. To this, you will usually add your share in the post-acquisition profits of S, which you still have to calculate. Then you will calculate goodwill. Now, goodwill over here can be calculated by using the NCI at fair value, which means this goodwill will be what? Will it be full goodwill or partial goodwill? That is full goodwill. So over here, this is working note number 2. Your goodwill workings. This will be, let us say, goodwill, your stake is 80%. However, the goodwill that you will calculate will be full goodwill. So over here, you will have particulars, rupees and rupees. You will have investments. Now this investment is like your purchase consideration, which you have invested for an 80% stake. Acha, you guys tell me, is this investment in debentures, investment in shares, or both? Sir, only shares. Why? Because you get control by acquiring shares. Payment to the owners is 5,800, and hence you will take 5,800. There is no existing stake, so there is no question of a remeasurement or anything. Debentures will not come over here. Next, you will go to your share of net worth. In this case, Is there full goodwill or partial goodwill? Full goodwill. And hence, will I have to calculate NCI as well separately? Yes, sir. NCI will be 20%, and they've said NCI as on the acquisition date is based on, so acquisition date is 1st April 2023, will be based on PC. So if 5,800 was for an 80% stake, then for a 20% stake, your NCI will be how much? 5,800 divided by 0.8 into 0.2. How much do you get? Sir, 1450. When you prepare your working note number 3 on NCI, for example, there is a working note number 3 on non-controlling interest. This is 20%. This is at fair market value. Your initial non-controlling interest. This will be the balance on 1st April 23. This is the fair market value. Can I say I will show this as 1450? Okay, now I need to subtract my share of the net worth or 100% of the net worth? Sir, 100% of the net worth. Why? I've taken PC of 80 plus NCI of 20, and hence I've taken 100%. With that, I'll have to compare 100% of the net worth, which will be the same as the net assets. On which date? Sir, date of acquisition. This is 1st April 23. On the date of acquisition, what was your equity share capital? Well, equity share capital was 4,000. Can I say the entire 100% will be taken over here? Yes, the entire 100%. Will I attribute separately 20% to NCI? No, because NCI is already taken at the fair market value as on the date of acquisition. Then comes your working note 4, which is your analysis of, let's say, your reserves. I think subsidiary has a single reserve, which is retained earnings. So if I look at this attribution, there will be total, pre and post. So if you go to see now over here, there is only one item which is remaining, which you have not taken, which was this 5,000. And hence I will take this 5,000. I will say that on 1st April, there was 3,000 in the retained earnings and other equity. So you will have balance on 1st April 23. This was given as 3,000. Ideally, to this you will add the profits of the year 23-24, which you don't have, but you can calculate. And if there was any dividend or if there was any bonus, you could have subtracted this, which does not appear to be the case over here. And hence there will be a balance on 31st March 24, which is, I think, 4,000, 5,000, and that's about it. So if this is 5,000, then during the year, can I say another 2,000 must have been earned? And hence 3,000 will go in the pre column. Acquisition is at the start of the year, and hence 2,000 will go in the post column. So you have attributed 3,000 and 2,000 over here. Now in this particular case, what do you guys think? Are there any adjustments? Yes, there are a few adjustments. So usually you leave around 8 to 10 lines if there are any adjustments to be incorporated over here, and then you can give adjusting entries. Remember, entries are not mandatory. However, for an understanding perspective, you can put in these entries in the exam. If you are clear, you can directly give the effects in the workings as well. So over here, if I were to take working note number 5, which is on adjustments, and if you see what are the adjustments over here, point number A will be your fair value adjustments. So over here, you will have fair value, which is maybe there is an increase of 300 and there is a reduction of 300. So over here, you can say initial fair value adjustment. Maybe I will debit the PP by the difference between 2,500 and 2,800, that is 300. But inventory is going down, so I will credit the inventory by 300. What do you guys think? Will there be any balancing figure to be taken to the pre-acquisition P&L? No. If there was a balancing figure, I would have taken to the pre-acquisition P&L, but this is nullifying. But there's a rate of depreciation of 10% which is given. So will there be any subsequent adjustment? Yes, but before that, I'll just give the effects on the PP. So due to this, your PP will go up by 300. Due to this, your inventories will go down by 300. Now, when I look at subsequent adjustment for depreciation, there would be subsequent depreciation. Now, the fair value of PP is increasing, so there will be an additional depreciation for the year 23-24, and hence your post-period profit and loss will reduce due to the additional depreciation. The second effect will go against the PP. Now, what is the amount? Well, this is 300 into 10% for a single year, and hence this can be 30 rupees. So if I do this, there will be an additional depreciation of 30 rupees. And in my post P&L section, I can say over here that in terms of adjustments there will be subsequent depreciation of 30, which will go in the post column of 30. Now for inventory, nothing is mentioned. So you can assume inventory is sold, in which case there will be a 300 rupee adjustment. On COGS, you will say COGS, which will be adjusting by 300, or if you assume it is unsold, usually institute assumes it to be unsold, but let's say assuming inventory is unsold, you will have no effect. However, if inventory was sold, if your inventory was sold, then you would have said debit what comes in, credit what goes out. Well, inventory goes out, but inventory is going out at 500. Your opening stock was 500 in your SFS, but in your CFS, your opening stock is only 300. Opening stock is only 200. Remember, when you calculate your COGS, your opening inventory in my SFS, I would have taken at 500. But in CFS, this would have been only taken at 200, and hence your COGS is falling by 300 rupees. And if it was there, we are not taking this, but if this was there, I would have taken that my COGS is falling. So post acquisition P&L, which will be impacting my COGS to the extent of 300, and inventory, I will negate that reduction of 300. So ये जो minus मैंने 300 करके रखा हुआ है, I will add it, and hence the effect on inventory will be nullified because the inventory is sold. However, over here, let us assume that inventory is unsold, and hence there will be no further effect. Are we clear? For this, you will have point number 2, which is done. Point number 3 is NCI at fair value. We have already taken that. Point number 4 is goodwill to be impaired. We will do that at the end. Here also you can take goodwill impairment because it is full goodwill. 80/20 will be attributable to parent and NCI, but let's keep this for the end. Then H sold goods of 200 on credit at a profit of 20% on sales. Okay, 50% of these goods were still lying or unsold. Now over here there is a problem. They have told you that H sold goods worth 200 lakhs to S. Now 200 lakhs is the cost price or the selling price. If nothing is given, that is the transaction value, and the transaction is at the selling price to H, that is 200 lakhs, and created a profit of 20% on sales. This is not 20% on cost, this is 20% on sales, and hence you can take 200 into 20% directly. That is 40 rupees would be the profit. However, 50% of this is unsold, and hence 20 rupees will be the underlying profit. Now, if you want to pass an entry, to be honest, this is not required. But if you have to find the underlying profit on downstream transaction, you will say the downstream means the profit is in the books of H, and I will credit the inventories. The profit over here will be 200, which is the selling price to H, into directly 20%. However, the entire profit need not be eliminated, as only 50% of the goods are remaining unsold, and hence your entry will be passed for the entire 20. And hence over here, if I go to see minus unrealized downstream profits would be reduced to the extent of 20, and the second effect will go against inventory, 20. Okay, so this has taken care of point number 5. Point number 6 says there is a check of 40 lakhs in favor, which is part payment. Okay, so over here, if I were to put an adjusting entry for the intercompany elimination, I will say trade payables which are appearing in the books of S. You will eliminate in the books of S whatever is appearing of 120. This was payable to H. In the books of H, there's a trade receivables. There's a receivable in the books of H which is from S. In my ledger, this is 160. However, there's a balance. This 40 over here will be shown as cash in transit or check in transit, and hence this will be added separately along with the cash and cash equivalents. So if I have to give the adjustments over here, on my trade payables, I will subtract 120. On my trade receivables, I will subtract 160. And on my cash, I will add 40. Are we clear with this? Okay, so this takes care of point 5. And then there is dividend point. Dividend payable represents dividend declared out of the pre-acquisition profits. Acha. This is dividend declared out of pre-acquisition profits. Okay, so there is a dividend which is there, which we kind of missed out. We'll have to give effect to that. H created its share of dividend from S to its profits. So when we do the analysis of reserves, there is a dividend. How much is the dividend? Well, 400. Sir, but is the entry passed? Yes, you must have in the subsidiary passed the entry. Usually it is a P&L account debit to bank if it is paid. Here it is unpaid. And hence this is dividend account debit to dividend payable. So this is 2000 over here. If I go to see 400, this 400 is coming out of which profits? Sir, pre-acquisition profits. And hence this 400 will be adjusted over here. So if I go to see, just a second, my balancing figure will be slightly different. This will be 3000 minus 400, and hence this is 2600 probably. No. 3000 minus 400 is 2600 minus 5000. This is 2400. This is your balancing figure, and hence the balancing figure is taken over here of 2400. Further, there is a dividend of 2000 of 400 which is paid after the date of acquisition or which is payable. However, you have adjusted it against your pre-acquisition profits because it is dividend out of pre-acquisition clearly given. Okay, so this is your working. Now usually if dividend is out of pre-acquisition profits, it should be reduced. Let's say from the investments over here, they have said that H has credited its share of dividend to its profits. So H must have passed the entry. For example, if I go to see for the pre-acquisition dividend, H must have passed the entry dividend receivable account debit to dividend income, and it has taken it to the P&L account. And due to this, when I find my net worth, I see that my net worth is only 2600. But is it correct? Is my net worth only 2600? No. My net worth would have had 3000 as on the date of acquisition, and hence over here, if I have to find the net worth, my entry over here would be, this is full goodwill. So over here, I would say P&L of the parent would be debited to the extent you have taken it over there. This would be 400 into 80%. Can I say this is going to be 320 to, let us say, overall net worth. You can do a shortcut over here as well, okay? You can do a shortcut over here as well, but nevertheless, if I were to say net worth 100%, if I had to increase the net worth, can I say dividend was later paid? But if I had a time machine and if I could go back, I can say that the net worth did not have retained earnings worth only 2600. They had retained earnings worth 2600 plus 400. The remaining is attributable to NCI, and hence your NCI would be debited by 80. But when I debit NCI by 80, I am saying that at a later date I must have paid the NCI. However, have I paid the NCI? Not yet. So we'll see what is to be done. But for this working, I will say this is a longer adjustment. You can even have a shorter adjustment, will give the same effect. But this is usually consistent. I can say minus pre-acquisition dividend, which is 320, which you have credited to your P&L, but it should not be. And hence we will reverse this. Further, I will credit pre-acquisition dividend to the tune of 400 over here, so that I can find the total net worth. And in NCI minus, I can say pre-acquisition dividend. NCI says मेरे को फर्क नहीं पड़ता. I don't care whether the dividend is pre or post acquisition, but I need to receive it. So over here, I am subtracting NCI because I have debited it. If the dividend was paid, it is like saying the fair market value over here must have been the cum dividend value. The total value of NCI is 1450, out of which I believe 80 would have been received. If it was received, then I subtract the 80 and hence I get the ex-dividend value, but 80 over here is not yet received. There is still a dividend payable and a dividend receivable. Are these intercompany items? Yes. So will they be need to be eliminated? Yes. So I will say dividend payable, like you had this in debtors and creditors. हमने बोला था sum of this balance was attributable to cash in transit. तो वहाँ पे here we'll have to figure out that this balance is attributable to whom. So there's a dividend payable which was appearing at 400. Okay. To dividend receivable, I can say in my final balance sheet this is appearing at 320. However, is there a remaining balance? Yes, sir. This 80 is attributable, is payable to whom? I have not yet paid it, but it is payable to whom? So it is payable to NCI. So NCI is saying that, okay, you have reduced me by 80 rupees for whatever reasons. However, I am still yet to receive that 80 rupees. And hence, when I eliminate it, I am saying that I am not just eliminating 320. Yes, 320 to knock off hona hi hai. But then, if I don't do anything, that 80 rupees will continue to appear as a dividend payable. However, that is clearly attributable to the NCI. And hence, I will give it to the NCI. Are we clear with this? And hence, over here, I will have a minus 320 from the dividend receivable, a minus 400 from the dividend payable, and in NCI, you will add NCI share of dividend, which is still payable, which is 80. Any other alternative effect where you kind of give the same ultimate effect. This is probably the longest way where we have done all the adjustments, but if you take a shortcut and ignore the NCI and do the working, probably that can also correlate. However, this will, in my opinion, be a foolproof working for this particular adjustment. Is there anything else? Yes, sir. There is still an intercompany investment in debentures. Now, these are in 1000 debentures, and every debenture is appearing to be worth how much? Every debenture appears to be worth rupees 100 each. And I've invested in, I think, 1000 debentures. So 1000 into 100, that will come to probably 1 lakh rupees. Or 1000 into 100 is 1 lakh rupees. If I were to look at the investment कितना है? 1500. ये तो lakhs में है. Just a second. This is 1000 debentures in S Limited. So this must be 1000 lakh debenture in S Limited. This is debenture worth 3000. So if I go to see, this is if I were to take 1000, ये lakhs लग रहा है. Everything seems to be in lakhs. So over here, if there are 3000 worth of debentures, I can say maybe 1000, that is 1/3 of them are held intercompany. So when I eliminate the liability over here, let's say I would say that there is an 8% debenture that I will eliminate to investment in debenture. I will also eliminate. Now investment in debenture will be eliminated to the extent of 1500 that I've invested. But debentures will be eliminated to the extent of the face value. Now the way I believe they have considered and would have been 3000, which is the total value, upon let's say 30 into 10. And hence this comes to let's say 1000. And hence the balancing figure over here will be the loss on elimination of debentures. This is 500. Remember, this is extra 500 paid by the parent. Instead of 1000, I've paid 1500 for acquiring, and hence this will be borne by the parent only in its consolidated P&L in working note number 1. So when I go to see over here, let us say this will be less 1500. Over here, if I go to see, this will be less 1000. And the remaining, we will say, is less loss on elimination of debentures. And this would be maybe 500. And with that, I believe all the adjustments pertaining to this question gets done. You will scan through the question and see if there's anything remaining. Yes, sir, there is still goodwill impairment remaining. So you will first find the goodwill and then do its impairment. So over here, if I were to take the attribution, I will try to do the attribution after all of these adjustments to the extent possible. So you'll get the adjusted balance. The adjusted balance over here will be 4970. Over here will be 2600. And this will be probably 2400 minus 30 comes to 2370. Does it tally? Yes. Now I can say that the usual attribution goes to H 80%, NCI 20%. So if I go to the post section very clearly, 1896 should go and 474 should go. So I will add in my NCI plus share in the post acquisition retained earnings. This will increase by 474. Aja, further I will add 1896 over here as my share in the post acquisition profits of the subsidiary. Now this is going in working note number 1, this is going in working note number 3. Now 2600 is the net worth or the reserves as on the date of acquisition. Here I am taking 100% of this for my full goodwill working, and hence if you want you can always attribute 2600 into 80% comes to 2080, and this will probably be 520. But can I say both of these will go in working note 2 only, because I have to calculate full goodwill and hence I will have to take the full reserves in working note 2. So this is your pre-acquisition retained earnings. This was at 2600. So 2600 plus 400, that is 3000, would have been the base. That will be there. Perfect. So we have taken all of this, and hence now I can try to find the goodwill. This is what, 4000 and 4000, and I think this is 7000. And if I were to calculate the goodwill, this goodwill on 1st April 23 will be, I think, 5800, 1450 minus 7000. Can I say this will be 250 worth of goodwill? And you have been told that out of this there is an impairment. Again, you don't need to separately pass the entry, but this will be something account debit to goodwill. According to you, who will bear the loss? Will the parent alone bear the goodwill impairment loss? No. Can I say parent and NCI both will bear? And hence this will be consolidated P&L account debit. This will be 80% of the loss. This 80 will go over here. NCI also has a share in the goodwill, and hence 20% of the loss will be borne by the NCI. You can even take this in the analysis of the reserves working, where you could ultimately give 80-20. So over here there will be less goodwill impairment, less impaired. So over here your impairment will be, let us say, 100, and hence your goodwill will be, I think, on 31st March 24, your goodwill will be around 150, which is remaining. Further, in your consolidated P&L, there will be less goodwill impairment. How much is a goodwill impairment? I think 80 rupees. And similarly, there will also be a goodwill impairment which is recorded in NCI because it is using full goodwill method. NCI will also bear a share. This is goodwill impairment. This is how much? 80 rupees. And as a result, now you have taken care of all the adjustments and you will try to balance out all of your balances. So this is your consolidated retained earning balance, which is 16,320, 1896 minus 20 minus 320 minus 500 minus 80. Maybe this is 17,296. This is 17,296 coming from working note number 1. There is no capital reserve over here. This is from working note number 1. Next, your goodwill has come to around 150, and your full NCI will be 1450 minus 80 plus 80 plus 474 minus again 20 rupees. I'm sorry, this was not 80, this is 20. So how much do we get? Is it 1904? Okay, so this is your NCI balance. Again, on 31st March 24, you have started with the NCI as on the acquisition date and then added the post-acquisition profits and losses, if any. So this will be around 1904. And then you will post these numbers, these three crucial numbers. Let's say goodwill from working note number 2, 150. Consolidate other equity, maybe either from working note number 1, or you can even say from note number, I think आपने अगर बनाया रहेगा note number 12. This is 17,296. and NCI from working note number 3, this is 1904. A lot of your marks are largely attributable to these line items. Other than that, what else do you have, sir? PP, which is 14800 plus 6000 plus 300 minus 30, 21070. Note number 1, 21070. Then your investment in debentures is eliminated. Inventories will come to what? 2600 plus 2000 minus 300 minus 20, maybe 4280. Assuming these inventories were unsold, if you assume it is sold, there will be a plus 300 adjustment over here, and also some differences in your post P&L working. So this is note number 3, I believe, which is 4280. Okay. Then you look at trade receivables and cash. Let's say for trade receivables, you'll have 7000 minus 160 comes to what? 6840. For cash, this will be 2540 including cash in transit. 6840 and 2540 including cash in transit. Then you will look at your dividend receivable. It is getting eliminated. In your debentures, you are still left with 2000. So this is debentures from note number 7. This is 2000. This is 8% debentures. If you want, you can write down over here 2000, and you will have trade payables worth 1700 and 600 minus 120 comes to 2180. This is 2180. On my trade payables, my dividend payable gets knocked off, and my other liabilities continue to appear at 1500. So this is, let us say, 8 and 10, 8 and 10, and then in note number 11, or you can even prepare a statement of changes in equity, you can have your share capital, which is probably 10,000. And now you can pray to all your gods and hope that your balance sheet tallies. 6840, 2540, and hence this appears to be 34,880, 10,000 and 27,296 plus 1904 plus 2000 plus 2180 plus 1500, and this comes to 34,880, and that secures your 14 marks in your November 2024 exams. Okay, so this is a fairly manageable question, but institute, like every other consolidation question, is trying to kind of mix and match a few adjustments and trying to give you, there can be alternative presentation formats or alternative assumptions which are possible. The question starts with telling you that you can make assumptions wherever necessary, and hence you can probably use assumptions for making a different type of a working. ठीक है.